Hello and welcome to this week's episode of The Capitalist Investor. You got me, One Take D, up at the top.
One Take
That's
D.
new.
That's
like
a little Easter egg.
I missed last week.
If anyone listened to all the way at the end, all the outtakes got put out there for everyone to hear.
Last week's podcast,
Yep.
take a listen towards the end. You can hear the blooper reel.
Yep, exactly.
Right.
So, Tony and Luke joining us today, the three amigos back. How we doing, fellas?
Man, what a week. What a difference a week makes is what
I'm
they
losing
say.
half my hair and then the other half's gray. So that tells you anything about my week so far. But no, it's a lot of stressful things happening around the world. That's what we're going to touch on today, right?
Yeah. You leave Ohio and the world falls apart, Luke.
It's all my fault. Everything, the office, COVID, the world collapsing, the whole banking system, depression possibly. Who knows what's going to happen? But I blame it all on me. I'm all about it.
All right. So basically what happened since the last podcast is a bank called Silicon Valley Bank in California collapsed. They defaulted, and the weekend pursued and didn't know what's going to happen. The feds jumped in. So I think I'm just going to start by, kind of giving like an elementary kind of basis of what happened and why they faltered. So first of all, this bank, SVB is what we'll just refer to it as. First thing is that they had a high concentration of very large depositors, basically tech companies, coming in and giving them hundreds of millions of dollars. So they had a small client base that had large chunks of money, and they all happen to be tech people, right? Because they're in Silicon Valley. Now, and that kind of makes it a little bit different than the regional banks and local banks that we're accustomed to, such as PNC, KeyBank, Huntington, where it's more of, I'll just call it more mom and pop type of deposits. Now we're not talking hundreds of millions. We're talking thousands, tens of thousands, hundreds of thousands of dollars.
And every person works in a different field and has different backgrounds.
Diversity.
Not everyone's in VC tech.
Right. So now that's the money that SVB took on, right? And now these people, these tech people, are going through a consolidation period, is what I'll call it. Interest rates are high; they need their money back, and they're coming and looking for it. Well, let's rewind the clock with what SVB did with the deposits. They took the money and they invested it. And they invested it in long duration bonds. Mm-hmm. And so over the last 1 or 2 years, they took that money, they invested in bonds, and in that time, interest rates went up. So the elementary way to explain that is, as interest rates go up, your bond asset goes down.
The interesting thing is, it doesn't even have to be long duration bonds. Look at the 2-year treasury.
Look
at the 2-year treasury note the past 5 days. It's went from 5% rates down to 4%. I mean, that's like a 5% increase in the IEF, I think, is the short-term duration bonds. I mean, that can be a huge, when you own $50 billion in assets invested and 5%, move on something like that. That's $2.5 billion that just went against you.
Yeah. So, and then what they, so it's basically bad management of the deposits that they use to invest. Now, to put that in perspective, just to give you some just general numbers, these numbers don't reflect what they actually invested, but to give you an insight of what actually happened is that they basically maybe took $1 billion of deposited money over the last 1 to 2 years. They bought, long duration bonds at maybe 1 or 2%. Fast forward to today, or even last week, when interest rates are 3 and 4%. The basic concept: the interest rates went up, the asset price went down. So their $1 billion investment 1 or 2 years ago is now worth $800 million. And when they come in looking for their deposits, it's where's the rest of the money? And that's where the Fed had to step in and basically cover the default range. For whatever the asset is worth today, based on what they invested it a few years ago, and that's why they defaulted, and that's why the Fed turned on the print machine, says, hey, we got this money fairy over here, and we're going to cover all of we'll cover all of this. Don't worry. And that's the basic idea of what happened.
Silicon Valley Bank must have had a lot of the Federal Reserve chair members on their board saying there was transitory inflation, and they must not have seen all these rate hikes coming. That's just insane. That's insane to me that you would position yourself unhedged, and when we're rising inflation rate environment, when we printed trillions of dollars, any kind of simple economist could, beginner economist that took economics 101 could have saw this coming. The Federal Reserve didn't see this coming.
Right.
The Federal Reserve didn't see it coming. These banks didn't see it coming. That's crazy.
So I really am gonna hang my hat on the absolute worst hedging of risk by a bank. I don't think this is bank wide. I think this is one bank that just had a bunch of dummies running the assets, running the investments, because banks are allowed to go out and invest the money. But they just came in and they never protected themselves against interest rates going up. They didn't do anything.
The banking system has significantly changed, which is very concerning for the future. And I think this is more of a not contagious to, like you said, all these different banks, like key banks, these small regional banks. But I think it says a lot about the whole overall banking sector in general, about how so many different financial, instruments are used now. Derivatives, options, like these, mortgage-backed securities. Obviously, you got collateral debt obligations, CDOs. You have all these crazy things. Back in the day, banking system was you give the money to the bank, they lend it out to somebody else, and that's it. Like that was as simple as it can be. Now It's so complex. If one little thing breaks, it becomes pretty extreme pretty quickly, and that's not good.
I'm just beside myself that they didn't really protect themselves against any type of risk. It is, and can it be a contagion because now we're just like Roku was one of their clients.
Yeah.
And if they can't get their money, they can't pay their clients. They go out of business, and now like Roku doesn't exist. And somebody come in and buy Roku. I mean that's the kind of domino effect I can see from this. But it's crazy on how levered they are right now.
Yep. So, I think you can obviously go about 1,000 different ways with this conversation, but there's always been, a tie to a political affiliation. But right now, regardless of your political affiliation, you must be losing faith in institutions. I mean, you just have to be. So maybe I'll start there.
Well, that's why crypto and Bitcoin blew up over the weekend in a good way. They were up like 20%.
They should. I mean, this is exactly what Bitcoin would prevent.
This is why Bitcoin was made, because 2008, 2009 happened.
Yep.
We basically made the bubble bigger by lowering rates back down to 0%, stimulating the economy. Free markets aren't free anymore. When the government's intervening, they're making these cycles more extreme. I think Satoshi Sakamoto, whatever his name is, that created Bitcoin, I think he saw that. I think he was one of the first people that saw how the banking system was just so corrupt, and this system we live in is kind of not free market capitalism anymore. And I think that what we're seeing right now, like you said, D, goes right hand in hand with why crypto came about in the first place. The question is it here to stay, or is the government going to go after it now?
Yeah, the government's going to shut it down.
Yeah.
That's what we've been saying for a while.
But now we're talking about, okay, now what does the Fed do?
Yeah,
because they had this terminal rate now of like 5.5%. We're at about 4.75, 4.8. Now they're just talking about stopping. Yeah, of stopping the increases, saying, "Hey, you guys went too far already. Look at the cracks." But is that a serious crack? Because I think that obviously they had to step in and backstop it, but I don't think the other banks are in trouble like this because they're not. They didn't blow up their investment by hedging. They didn't. Everyone's probably doing a lot smarter things than Silicon Valley Bank. That's just my opinion. Like it was just some bad decisions.
So what are the regulators doing, right? So what is, how does no one have a problem with the CEO of this bank on the board?
Yeah, I was talking about that. Yeah, he was on
of the Fed in San Francisco, right?
Yeah,
is that what you said?
Yeah, like nothing to see here, guys.
Wow, I mean, like there's red flags everywhere. So who is regulating what, or are they doing this on purpose? Like, how can you not get there?
Right?
I know I'm going Illuminati on you, but 2.7% of the SVB deposit was under that $250,000 threshold, basically. So 2.7% when the average is 30%.
From other regional banks like the key banks, the PNCs, the Huntingtons of the world, right?
Exactly,
is that what you're saying?
Exactly right.
So put that say that again. Like there's 2.7. What does that mean?
So if you drive down the road to Huntington, basically 30% of the money, around 30%. This is the nationwide average. About 30% will be insured, essentially.
Under $250,000
$250,000
Gotcha.
of the FDIC insurance. At SVB, it was 2.7%.
So everyone had more than 250
yeah.
grand.
So right away, that's a red flag. Right. And when you talk about risking interest rate risk, they have a lot more money than the average regional bank based on the region that they're in, obviously. They had zero inflation hedges in place. None. Zero. Not one whatsoever. So when when you're buying big chunks of like huge amounts, right? Big chunks of bonds, you're buying financial products like mortgage-backed securities based on the interest rate of the time. Your obvious, besides defaulting, your obvious risk is if interest rates go up, this investment isn't going to be as good. In an environment where everyone, including us, said, "Hey, inflation is getting out of hand." We're talking 2 years ago, right? It's not transitory. So all of these things going on, and there isn't one single inflation hedge on this huge book of assets. Like,
I know it's.
I mean, you can call it incompetence if you want, but
I think there's a point to where either one, you're born into just a ton of money.
Mm-hmm.
Or two, you make a lot of money, you've lived that lifestyle for a long time, you become kind of disconnected sometimes. I think that's kind of what we're seeing over in Silicon Valley, is you kind of have this woke crowd, very liberal, left-wing woke crowd that becomes disconnected from reality, if that makes sense.
That's exactly right.
And they don't necessarily understand risk management anymore. If that they think money grows on trees, because it did for 13 years straight. We have that psychological impact.
Mm-hmm.
I think that definitely has an influence on why we're kind of in the situation we are in today's world. And there is a lot of incompetence, smart people with degrees, and all these people we perceive as smart. I mean, are they really smart anymore? I mean, or they just live in a system that was completely falsified in a bubble for so long.
Yeah, I mean, you kind of listen. Again, the Twitter machine's an amazing place to just. I don't even know if it's fact or fiction anymore, but I mean, they make comments where somebody will give a $10 million deposit. Or $1 million. Actually, let me go reverse. Like, they'll give $1 million deposit and they get a magical 1% mortgage rate on a $10 million house. I mean, those are the kind of deals. Through the grapevine, you'll hear that Silicon Valley Bank was issuing to large depositors.
I tweeted this just today, actually. One thing I said was, when everyone has money and life is good because an economy becomes built on 0% interest rates, people find anything and everything to complain about, which has contributed to woke culture and companies going woke the past decade. Silicon Valley Bank was pushing green agendas. They were pushing all the woke stuff that we hear about in the media. They were pushing all for it. And the thing is, I think you get a call off sides because you're not paying attention to what actually matters. You're actually focusing on stuff that's irrelevant in the big scheme of things. When you actually have to tighten up and the economy's not too hot.
Well, and now the figures being pointed at Trump rolling back some of the regulations, and everyone was partaking in the rollback of regulations, and now when the proverbial poop hits the fan, now everyone's like, "Oh, it was him! It was him over there. That was his fault."
And those aren't the regulations they're talking about. Is a talking point. It's not even related to what's going on.
Right? They made things easier for the regional banks to compete with the bigger banks.
Right.
Now,
here,
but they were supposed to have an oversight committee to make sure shenanigans like Silicon Valley Bank weren't going on.
Yeah, SVB. Had a gigantic investment portfolio. 57% of its total assets were invested. Basically, the average U.S. bank 24%. And of their investment, 78% was in mortgage-backed securities. Well, 78%. So it's so bad, it's hard to even discern what's going on. But it seems to me like the most reasonable explanation is they got so far down a path on being greedy, essentially, that they just kept going down that path because they knew they would be bailed out at the end if it didn't work out.
I think that's how a lot of these companies, if you think back to the past 13 years, when you can get money so cheaply, I think the end goal for a lot of these tech companies was to build up as quick as possible, get as much revenue, even if it was unprofitable, just drive as much revenue and then sell it to somebody else and get rich. That was the game plan for the past 13 years. And I think that people thought this charade would go on another 10 years and could get away with, like you said, incompetence of just growing revenue some way, somehow, and not worrying about the actual bottom line profitability.
Yeah, and so all right, so they messed up. That's all jacked up, and they're out of business. And the Fed came back and, well, I'm just going to call it a bailout. You call it what you want. Like, hey, they're just helping the depositors. They're not going out and helping the investors and the bank itself and the bondholders. That's on them for a bad investment. But they are backstopping the investor. Or the depositor, I should say.
Right.
So now the windfall, the backlash is, there's crypto is now being affected. Interest rates, what do they do? What does the Fed do with that? The market doesn't like this, obviously. Inflation, I think the interest rates and inflation are tied together. I watched this Sven Henrik on Twitter. I think he's on Fox and CNBC quite a bit, and I like what he has to say because he seems realist, and he goes, inside Powell's brain right now, if I raise 50 basis points, it signals I blew things up. If I raise by 25, I may still blow things up. If I don't do anything at all, I lose credibility, and if I start cutting and I panicked, I may blow things up. So
you're saying there's a chance there's a soft landing? No, there's not. There's not soft landing at all for all those people out there that still are saying the soft landing's on the table.
Did you see Jim Cramer like 3 days ago said basically they're about to stick the soft landing?
They're about to stick it?
Yeah. Like the inverse.
Was
the
that
inverse
on
Cramer
Thursday or
must
Friday?
be blowing up.
Is that on Thursday?
Yeah,
or
I saw
Friday?
it on Twitter.
He said it? Yeah, before the real news came out. They're about to stick it.
Wednesday or Thursday, probably.
The writings, here's the thing is, in this industry, there's always talk about being contrarian, and I think a lot of people are about to get themselves in trouble being too much of a contrarian. Like the writing's on the wall. Like the writing's on the wall for some things. You definitely have to position your portfolio defensively, which we're doing, and things like that, right? I think that's a lot of people are trying to take these big risk and high growth names, or saying that we are going to have soft landing positioning for something like that, and there's too much contrarian, I still think, out there that people got used to that thinking when rates are 0%, or at least when you can pivot down to 0%, when you don't have inflation, things like that, you can be a contrarian because you get bailed out. You're not going to get bailed out this time.
Yeah, I asked, so Schwab, the custodian of our stocks and items like that, has really taken a big hit. They're not even a bank. I mean, they do have a banking division, but they're primarily asset gatherers. And then you have, their stock has really taken a hit. They make, they're a $20 billion company. They're a big company. And I asked one of our investment guys, I'm like, is this a time to buy a company like Schwab? There's a lot of assets there. They consolidated with TD Ameritrade. Is this a time to buy it? Because you got their CEO on there saying, I'm buying more of the instant, people are moving their money to us to buy our stock, blah, 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 so like, and his simple answer is like, where there's smoke, there's fire. So we're not buyers right now on these assets that are highly depreciated until, we just see more clarity and really see the fallout. But my one buddy sent me a text and he goes, over the next 6 months, what is the most likely scenario? And he goes, hyperinflation, a depression, a collapse of our banking system, or a fourth. What am I missing? And it's like, holy cow. I mean, like, I don't know. Those are valid questions.
They're all possible.
Because look what happened in a week. And obviously, I don't want a market crash. Obviously, hyperinflation. If they pause or pivot on the interest rates, you thought things were expensive. Now wait, they'll get really expensive.
You have a trade-off here. You either get rid of inflation or you destroy asset.
Yeah,
you get rid of you
up.
blow everything up.
Yeah.
Or you let inflation run hot, or you blow everything up. Those are the two scenarios. I mean, each one is a bad scenario for everybody involved. And that's why
within 1 year, we increased interest rates by 4%, over 4%.
Look, we can delay this game we can do what we did in 08 and 09.
Mm-hmm.
We can do this. You can do this game forever. Like, we can do this for another 50 years, 100 years, but eventually the system collapses on itself if you keep on doing what we're doing.
Yeah.
That's what I'm saying. So the question now, the balancing act is not whether it's hard landing or soft landing. The balancing act is getting some sort of landing that's not completely putting us underwater to where we do have a depression, but also making sure that inflation doesn't stay upwards of 5% for very long, right? 4%, 5% very long. So, I mean, that's the game's tricky right now. My long-term solution that I hope for my kids, for my grandkids, for future generations on for America as a whole, my hoping is that they do continue to take some liquidity out of the system, is that they maintain that hard stance, because we got to get back to free market capitalism, free market innovation, not government controlled and Federal Reserve controlled innovation.
But they just turned the print machine on to cover Silicon Valley Bank. That's what they did. They said, we're going to backstop this.
Middle class America will pay for everything. That's what people understand.
I think through inflation, though. I don't think you're going to get an actual tax bill for this, but they printed more money.
Or you get less interest on your accounts or something like that.
Or they just jack up the interest. Yeah. You get less interest, or they jack up the interest rates on
some way you pay for it.
Middle
class is the problem with this environment. Middle class America always pays for it. This is the problem. Is no matter what the government does, middle class America pays for it. If we operate in a true free market system, middle class would be growing, not shrinking.
Yeah.
Absolutely right. Yep, absolutely right. And Mark and I have been saying that since the beginning. The capitalism is supposed to lift up the people at the bottom, and with government handouts type socialism type things, it keeps those people down.
Yeah.
Yeah, I think I heard Mark on Fox today, and he said, by continuing to bail out the failures, we're not creating capitalism,
right?
And we're not flushing the system,
right?
And we're just creating more money.
There should never be such a thing as a bailout. 99% of the time, I get there's some certain scenarios to where you need to protect the average person.
Yeah,
but 99% of the times you should just let capitalism work itself out, because if you don't, you create other issues somewhere else.
Yep,
is what we're seeing. I mean, we talked about this during COVID, like, guys, 3 years ago.
Yeah,
we were talking about literally as they were handing out unemployment benefits, stimmy checks. We were talking about the impacts this was going to have. Fast forward to now, you are seeing exactly what we were talking about and why we were talking about it. But everyone ignored it. No one pays attention. That's the problem in today's world. Is we live in this fairy tale world. We think that's perfect, and it's not. You got to pay attention to it. And we're trying to spread the word of that. It's hard, but we're trying.
Hard work is the American dream, and the last 2-3 years, it's not been very hard to make money and have money.
When you can work 4 hours out of the day working from home and make $150,000 a year, I mean, that doesn't last.
Sign me up, please.
Right.
Yeah, we got our engineer's like, hey, Luke, where do I send my resume?
Not anymore. Can't do that anymore.
Right. So, this is obviously developing. As this podcast is being taped on Wednesday, it'll be sent out tomorrow on Thursday. The European banks are blowing up now. They're having major issues because of lack of, credit.
Yep.
They're some of their backstops are dissipating and saying, hey, you guys are on your own, and the panic is on. So we'll see how much it unfolds and who steps
Japan,
up.
Steve Forbes actually said something interesting today. Japan's got, when you compare GDP to their debt, Japan's got like double the amount of debt the U.S. does. I mean, that obviously goes throughout the banking system as well.
Wow, they're like at 200%.
Yeah, like 220.
Yeah, because
we're 125.
We're 125.
Yeah, so 125% of GDP. But yeah, it's crazy to think about. We think America's bad. Look at some of these other countries.
I gotta find this statistic, and I want to say it was like a Peter Schiff.
I love Peter Schiff.
Peter Schiff type of comment, And he said whenever a country, going back all the way to like the Romans, the Roman Empire, whenever you're above 100% debt to GDP levels, I forget the time frame, but that it crumbles. That civilization crumbles because it's suffocating debt, and you can't sustain it, and we're there. I don't know if it's like, hey, from there it's like 25 years or whatever, but we were at 100 or 125 back probably about 10 or 15 years ago. And we got to like 80 and things were sustainable, and then boom, we printed a ton of money, and now it blew up again. So I don't know, I got to find that statistic.
My buddy just bought a house, disconnected from everything, on top of a hill, 4 wells, 4 freezers, generator. Might have to go do the same. It's not that. Listen, at the end of the day, I think Michael Gade is his name. I follow him on Twitter, talking about Twitter. Yeah. I think he's got some interesting points. Like, the end of the world is a bull case, because if the end of the world does come, if the end of the world does come, the last thing we're worried about is kind of what we're talking about right here. So at the end of the day, we're very pessimistic in this episode. I think we'll come out of this, as we always do. There's just going to be more pain, I think, than a lot of people really understand. And it's not just, I don't think this time the pain is going to trickle down to middle class America, but I think the pain's actually going to be in a lot of the wealthy, the wealthy folks that have a lot of money exposed in these high growth areas that got rich the past 13 years. A lot of them don't know risk management. I think you're going to see a lot of that. That's why, that's why you need a risk manager. You need somebody there to kind of tell you there. Yeah.
Risk management. That's, I know we don't have much exposure to financials. We haven't for quite some time.
Or technology. I think the bubbles in technology, these high growth tech names that got completely whooped. I mean, not the Apples of the world, not the Amazons of the world. I'm talking about these companies that are completely unprofitable, that didn't turn profitable in 13 years straight with low 0% rates. How in the hell are they going to be able to turn profitable with higher rates?
Yeah,
those are the companies blowing up.
Their debt to service their debt went from 1% to 2% to 7% within a year. And if you're carrying a couple $1 million in debt, that's some hundreds of thousands of dollars in just interest payments. It's huge.
But I think that's to sum that up, Silicon Valley Bank. I think that sums up not just the banking sector, but I think it sums up a little bit about the tech sector and how exposed it is and how unmanaged risk it is, if that makes sense.
Yeah. All right. A little somber today, but let's see how this shakes out, because a lot of things happened since last week. Even the yield curve is steepening. Everything's kind of flattening out.
Yep.
So we'll see how this plays out.
Yep.
All right. Thanks, everyone, for listening this week. If you have any questions, comments, concerns, hit us up at info@swpconnect.com, and we will talk to you next week.
And have a good St. Patty's Day.
Yeah, happy St. Patrick's Day.